These guys are great. We're going to talk a little bit more about volatility. I want to thank, this doesn't get put together overnight. This is about 120 days of work and constant work. We were up every night for the last 2 weeks working on this, and Tina is responsible. You guys know that. Our team knows that. But Tina put this whole thing together, got all of you guys here, got the speakers, and did a great job. Tina, thank you very much. So, where are we? Oh, yes. So I have some objectives. I want to provide some insight into market measure, how the market actually measures volatility. And then we want to talk a little bit about the overabundance of data. And Andy spoke about that. He said there's so much information, and we're going to talk a little bit about that. We're going to highlight 2 investments that allow you to be long volatility if you think volatility is going up, and short volatility if you think it's going down. And we're going to demonstrate a method that we use, and Caroline mentioned the tactical portion of our portfolio. Most every investor with Beacon has a tactical position, and PVSYX, which is Caroline's fund, is in that tactical portfolio. And we're going to demonstrate a method when we use ETFs that we trade through Andy. How do we determine when to be in and when to be out of the market? So when we were putting a presentation together, I said, okay, I'll define standard deviation, which is a statistical term that measures the amount of variability or dispersion around an average. And I put the formula up there so everyone, you all remember that formula. And Tina looked at me and she goes, wait a minute, this is not a simple formula. I said, yeah, this is pretty simple. Right? So if you're a statistics major, and as I did in grad school, yeah, it's a simple formula. But it makes an assumption. And it makes an assumption that if we have the average return, that everything is symmetrical around that average. Who believes it? You believe it is symmetrical. You believe that returns are symmetrical around that average. I will tell you that volatility does revert to the mean, which it means it does come back to this mean, but I don't think that the market in the last 3 years has been symmetrical. I think it's been asymmetric. And I think that you need to understand that volatility is pushing this asymmetric problem further and further. We saw it in 2011. We saw it in 2008. In 2008 is where we really started to look at it and say, wait a minute, this kind of standard statistical measure isn't really working anymore. We need to do something just a little bit different. Volatility is linked to the options in the market, and Andy spoke about it, that investors want an indication of where market activity is going. And someone always says to me, well, where's the market going? And I said, well, if I knew that, you'd be sending all your money to me down in the islands because that's where I would be living. But we don't always know where the market's going, whether it's going to be up or down. But more important, in our opinion, is the magnitude. How high is that line on the volatility scale? That's really important to us. So options, either the puts or the calls, tell us what sophisticated investors expect, and that's how we derive the volatility number. Professional investors are watching the options. Where do you find out about this? You go to Google, you go on the internet, and you can find as much gosh darn information as you want. TD Ameritrade's here, iShares is here, Putnam's here, Fidelity's here, people from Russell are here, Charles Schwab, CNBC, Yahoo Finance, Charts.com, Chicago Board of Options. You can go any place you want. But if you think you're going to have time to analyze all of that information, I think you're in for a big surprise. Other than Des, okay, no one really has the time to do all the analysis because he retired, decided that what he was going to do was learn all of this stuff, right? So, and when we're dealing with volatility, we're looking at this intensely short period of time. We're only looking at 21 days as we look at what the volatility actually is measuring. There's so much information. This was actually something that came from Stock Touch for iPad. You can get it on your iPhone. You can take a look at every one of the main sectors of the S&P and all of the U.S. markets. You can take a look at what's going up, what's going down, how much volatility, what's the standard deviation, right on your phone. And you can get all of your charts, everything, real time, real live prices, anytime you want it. So if you want information, you can get as much information as you can possibly absorb. And what we find is most people can't really absorb that information. So let's talk about the VIX This is the fear index. Okay? The VIX means that you're going to be long volatility. What does it mean? You think that the market and that volatility is going up. What we have here, this is the VIX. This is what's actually happened since December 2011. Volatility has gone down. This is the inverse of the VIX, which is where one of our investments in one of our separate pools is right now. We actually are invested in the inverse of the VIX because we believe that volatility continues to go down for at least another 21 days. We don't know what's going to happen at the end of that 21 days. So, excuse me, this actually shows what's happened to the S&P 500, which is up about 14%. Meanwhile, the XIV was up about 60% in the period from December 11th to here. However, Monday it dropped 10%. Bingo, just like that. And you see that the drops are big and they're fast. Again, not for the faint of heart, not for the long-term investor, something just a little bit different. Oh, sorry. So we're going to show you here a little bit more about statistics. Everyone has this in their presentation, and you can follow along, you can mark notes, and if you really want to determine our opinion, if you want to determine when to get in and out of the market, you must understand some basic statistics. We would love to say that we have always been using this model. We actually started using it late in the fall. And we started to use it once we had back-tested it 5 years through the worst part of the market all the way back to 2007. This happens to be the SPY that Andy was talking about, SPY, which is the S&P 500. What this shows you right here is the daily action, the daily stock price of the S&P 500. Shows you its high point, shows you its low point. So we actually track, and you can get this real time. We see it real live time all day long on our screen, and shows us what's going on. These are moving averages. So if we have a 200-day moving average, we take the stock price every day. For the last 200 days, divided by 200, we know what our average price is. We do it for 15 days, we do it for 50 days. What we have determined is when the daily stock price moves below all of those averages, it is an indicator of when to get out of the market. As it starts to move above the daily averages, it is an indicator of when to get in the market. So you can sit and watch this and get some of your own indications of when to go in and out of the market. What we found is it's not 100% effective. We need a little bit more information. So what we put in is we said, let's take a look at the volatility of the average. So, Fred, you will love this, okay? And you're probably going to figure out all the numbers and tell us if all of our numbers are right. But this is what we call Jenkins volatility. And what it does is it looks at the volatility of the moving averages. And we notice that when this starts to go up, it's telling us it looks like it's time to get out. As it starts to decline, it's time to get in. What this model will not do for anyone is tell you what to invest in. That we do from a macroeconomic perspective to determine where we should be in the market based on what is going on in the marketplace. So this is two of the indicators, and then we have the third indicator. Because we found that we weren't 100% dead on and when to get out of the market when we looked at the first two variables. Let's look at the third variable, which is merging and diverging from the moving average. So if the moving average is going above the zero line, okay, it's crossed the signal line, it's time to make a move. It's crossed the signal line past zero, it's time to get out of the market. Interesting, when was it time to get out of the market? In August of 2011. I wish we had this model August 3rd, 2011. We did not. We are not the first people to create it. Okay, so we're not geniuses. We just happened to go out there and find out, how did people figure this all out? Well, notice the circles. All three indicators said, get the heck out of the market. What happened? October. Get back in the market. Yes?
All the time ranges are different. So if you take a look at the EMA, you got 200-day.
You can't ask that question yet,
Okay.
but I'll answer it right now. Okay, what Showman pointed out is some of the moving averages, the timelines are slightly different, and that's true. Okay, because Chaikin does their volatility a little bit differently, but they all fall in on the same dates. So what Showman is saying is you had 15, 50, and 200 exponential moving averages here, but down here you've got a 10. You've got a 10-day. Down here, what do we have? 12 and 29. Or 12 and 20. Am I reading it right? 12 and 26? Okay? So the days are slightly different, the amount of days that the moving average is, but this is what we found predicted with about, David, 98? 100? That's David Hune, former student here at FDU, now works with us. He was in my CFP class. He takes the investment class and account. He says, Des, that taking my investment class was the real reason why he passed the CFP exam the first time through. So you guys are in great hands. Anyway, this is a model. Does it work? You have to be religious about it, have to follow it, but it is working. We find that it happens to be working quite well. So what did we figure out in all of our processes? What did we figure out about volatility? And we spent an enormous amount of time and energy last year trying to figure this out, because the things that we did in 2008 didn't quite work in 2011. So we went back and we said, okay, how can we make them work in 2011 and beyond? Low volatility, we found, allows a portfolio to compound more effectively. In order to have low volatility, you have to be out of the market when the volatility moves up. So we believe that getting out of the market is more important than the exact timing of when to get in the market. Market returns are hypothetical on actual portfolios all the way back to 1929. Low volatility exceeds the return of the S&P. So if you get low volatility, your return is actually higher than if you're in high volatility, which is the antithesis of what most people would believe. Most people would believe if I take more risk, my portfolio will do better and my compound rate of return will be higher. Oh, we have an anomaly. And that anomaly is that low volatility is much better than high volatility, but low volatility needs to be exploited by being part of an integrated asset allocation strategy. You must know which components of the market you want to be in by doing some type of macro analysis to determine where you should be. Obviously, we should all be in municipal bonds. You wanted me to say that, right? Okay. Andrew Clinton from Stanford manages municipal bonds for a number of our clients, so I had to make sure I get a little bit in on that. But harnessing volatility over a long investment horizon, low volatility allows the compounding effect. Compounding is how you make money. It's earning money on your earnings. And that's how you make money. If all you do is take it out and you don't allow it to compound, you're not going to make as much. So over the long investment horizon, low volatility allows the compounding effect of the stocks in the portfolio to grow undisturbed to maximize the investor's terminal wealth. Harinda De Silva, CFA, President and Portfolio Manager. We got this through Russell Investments. They sent us some white papers. We loved it. We thought this was great. We want to thank again TD Ameritrade, Putnam Mainstay, iShares for all of their help. I want to thank everyone for coming tonight.